Hello, everyone, and welcome to our presentation on the Never Tax Retirement Strategy. My name is Rajesh Jyotishi. I'm your host, and I'm really excited to have you here with us. I think you're really going to find this presentation very, very useful. I have my friend John Oldham here with us, and John is an incredible presenter. So let me start you out with a little story, which is pretty interesting. I was watching Robert Kiyosaki, the author of Rich Dad, Poor Dad books on somebody else's YouTube podcast. And what he said was kind of took me back a little bit. He said that, if you're poor, you should listen to Susie Orman. If you're middle class, you should listen to Dave Ramsey. And if you're rich or well off, maybe you should listen to somebody else. I was like, man, that's pretty arrogant, isn't it? But then when after some thought, I said, well, there is some truth to that because, everybody has a different challenges at different levels. And one thing I've known over the last 30 years, and by the way, this is my 30th year anniversary in the financial services. What an incredible ride it has been up to now. Is that one thing I've noticed is that the financial services is always evolving and changing in a good sort of way, just like our cell phones, cars, and everything else that we have in the world today. So with that in mind, there's so many different innovative products and strategies that have come up in the last few years that most people are not even aware of. And it is part of my job to bring these solutions to you, our clients and our friends. So with that, keep an open mind as we go through the rest of this presentation. And with that, I'd like to introduce my guest speaker, John Odom. So John is a 20-year veteran of the financial services industry. He joined Thrivent at the age of 22 and became a top producer with them. Then later he went to New York Life and MetLife and became an independent advisor in 2010. Now he's a national educator and works with advisors like me to educate our clients in the various financial strategies. He resides in Gold Canyon, Arizona with his wife, 2 kids, and 3 cats. He loves golf and barbecue. And with that, John, my friend, I'd like to hand it over to you.
Well, thanks, RJ. Really great to be here today with you. For all of you that know RJ, you probably enjoy his presence just as much as I do. And I'm thankful that you have that connection with him. He's truly the best of the best. I'm excited to share a little bit of this with you guys today. And we do have the chat box, the Q&A open that RJ will be taking a look at as we go through our brief presentation here. And we'll have the ability to have an offer for you to get some personalized information here at the end. So again, I appreciate you spending some time with us today. So I think in the big scope of planning, as I've done not only for myself and my family, but for other families across the country, thinking about what is the biggest hindrance to wealth creation, taxes end up being at the top of that list. So if your planner, your advisor, your CPA is not talking about long-term taxation with you, I think this is going to be an eye-opening experience for you today. So data is still coming in from the year 2020, but let's take a look at the year 2019 in review, because this should give us a little bit of thought process on where we're going. And if we take a look at 2019, the stock market had hit all-time highs, record low unemployment. So if you think of what the government, the quote unquote business that the government is in, right, they collect revenues from taxes. And when stock markets are at the all-time high, that means people's earnings are at the all-time high. Income taxes should be at the all-time high. Capital gains taxes should be at an all-time high, right? And unemployment being at record low, that means that the government should be paying out the least amount of benefits in those types of programs. So they really in 2019 had the wind at their sails, and at their back, and it should have been a really good year. But take a look at this. In 2019, the US government still managed to lose $8 trillion with a T dollars. Just awful, just awful. So this is a website that I frequent, and you can as well. And there's some key pieces of information. This is called usdebtclock.org. And if you go to usdebtclock.org, what you're going to see is all of these boxes with these numbers are just spinning. So it's all real time. And the great news is that wherever you put your mouse, it up this box where it says usdebtclock.org will change, and it'll cite the source of the information. So you don't have to think that this is someone making this information up. So there's a few numbers here that I'd like you to take a look at. First is this upper left-hand corner, which is where it says US national debt. And the Treasury Department will tell us that we have $27 trillion of US federal debt, right? But again, that is not the big story. That is not the big story. The big story is down here in this bottom right-hand corner, smaller number, and it says US unfunded liabilities. So what does that mean? Unfunded liabilities. Well, liabilities means that it's it's something that is owed. The government has already made those promises and have voted to pass bills to pay those, right? To pay for those things. Unfunded is the scary word to me. That means that although they've promised to pay that amount of stuff, it's not been accounted for. The government has not voted on where to get the money to pay for that stuff. It's $158 trillion. So let me take a look at what an unfunded liability really is. If you take a look, again, this is right from the US Treasury. The unfunded liability is just 5 things: Social Security, Medicare, federal debt, federal employee benefits, and veteran benefits. Let me ask you a question. Which one of those 5 things, Social Security, Medicare, federal debt, veteran employee pensions, and veteran employee pensions, are you or the rest of America going to be okay with the government defaulting on? If you want to get everybody to come on the same side and unite together, how about we go and slash Social Security by 50%? Everybody in Washington will be out of office faster than you can snap your fingers, right? But this is true money that it's a problem that the government's going to need to solve. And watch this. If we go up in this upper right-hand corner where it says debt clock time machine, you can click there and we fast forward just 4 years. Look at this number. The US national debt has gone from 27 trillion to 49 trillion in just 4 years. Guys, that's $22 trillion that the Treasury Department is telling you that they're going to rack up in debt in 4 years. But again, that's not the real story. Look at down here. Those unfunded liabilities went up to $205 trillion. 50 trillion of additional debt in just 4 years. And this has nothing to do with any of the new policies that are being tossed around in Washington today, like forgiving student debt and the new Green Deal and a lot of these other things. This is just stuff that's already been voted on and passed. If that doesn't open your eyes, I'm not doing a good job, right? So for those of you that have access to that chat box, if debt, the US national debt is something that concerns you, I'd love you just to go to the chat box down there and just type in debt. Just type that in. I love this to be interactive as we're here working through this information together today. So let's take a look at our first thing that might make you want to scratch your head, right? As I'm kind of a math nerd. And when I go through and do math and see these statistics, they make me go, like, what are you going to do about this? So this is a question that I have for you folks. Have any of you ever taken a tax deduction off of your earnings and put money into an IRA, a 401k, a 403b, a simple, a SEP, any of those qualified retirement plans? Has anyone done it? I'd be willing to bet that 99% of you on this call have done that one way or another over your lifetime. But when you took that deduction, you entered into a partnership with the government, right? You said, okay, I'm not going to pay taxes on this money today, but I'll pay you later, right? But when you entered into that partnership, you gave them, the government, all the power to make the rules and take as much as they want when they need it from that money. Have you ever thought about it that way? They have the power. They set the tax rates. They will take as much as they want when they need it. You think they're going to need some money? You just looked at the numbers. Where is that going to come from? I ask you a question. On a scale of 1 to 10, how much do you trust Washington politicians to do the right thing with your money, your tax money, your um, retirement money? Type it in, type it into the chat box. How much do you really trust those Washington politicians to do the right thing? Right? Think about it, right? So, what are you going to do about it? You have a choice. The beautiful thing about America is any challenges that we face, we have choices. We can take control of our lives. We don't have to let the government sit there and control us, right? So part of the problem with these numbers and when they get thrown around out there is it all sounds the same. A million sounds like a billion, sounds like a trillion. And I call it the million, billion, trillion sisters. So my favorite beverage. I drink too much of it, but my favorite beverage is Diet Mountain Dew. And if you gave me enough Diet Mountain Dew, I believe that I could count to a million because a million seconds is 11 and a half days, right? A million seconds, 11 and a half days. You give me enough Diet Dew, I could be hopped up on enough caffeine. I might be able to stay awake for 11 and a half days, right? But a billion seconds is 32 years, right? What about a trillion? A trillion seconds is 32,000 years. So a trillion versus a million is a huge difference. And keep in mind that number, over $200 trillion. Where do we get this money? Where do we get this money? Let's look at Social Security and Medicare, right? If we take a look at Social Security and Medicare, how many Americans do you think are on Social Security and Medicare today? If you want to use the chat box, feel free to type it in. How many people do you think are on Social Security and Medicare today? You know, we know it's going to be higher in the future. We know the number is going to get higher because of the baby boomers. There's 63 million people that are currently on Social Security and Medicare, 63 million. And if you look at the statements about Social Security and Medicare, they're already reaching negative cash flow. Negative cash flow meaning paying out more than you're taking in. Not good in your personal finances, certainly not good in a program like this either, right? But look at this, in just 25 years, 140 million people are going to be on these programs. What does that tell us? It tells us that's about 80 million people less paying into the programs and 80 million more taking out of the programs. You know, where do we get all the money for these things? Right? Where do we get it? Where do we get it? Because at the core of what the government is, at the core of what they are, they're a wealth or a money transfer device, right? They have to get it from somewhere to give it to something else, right? So there's really only two, and you could say a third way that the government can get money, right? The first way they can get money is they can print it. And they've been printing and printing and printing and printing for 20 years. If you go back to that usdebtclock.org and kind of the middle lower left, there's something that says M2, which is the money supply. And it shows that in the year 2000, we had 300 million Americans in the year 2000. And we had about $4.7 trillion of cash floating around out there. If we go forward today, 20 years later, we have about 330 million Americans. So our population is up by 10%. But guess what? Our cash is up by 400%. They've been printing so much capital, it'll make your head spin. And when you think about that, eventually, if you print more of something, you decrease its value, you decrease the value of that dollar, and that can lead to something that's called inflation. Imagine if your plan was to retire and live on $50,000 a year, but all of a sudden those goods cost $75,000 because of inflation. Would that be a problem? My great grandmother is still living. She just moved into assisted living, but she pretty much still takes care of herself 100%. You think her Social Security check has changed at all or the buying power of that has changed at all. She's 102 than when she first received Social Security. I mean, inflation is a big problem, big problem. The second way they get money is raise taxes. You think there's a good chance that they're going to have to raise taxes over the next 20, 30, 40 years to deal with some of these issues? I will bet that they have to, and they will. The third that you could add into here is reduce spending, but nobody in Washington has talked about reducing spending in 20 years. And a matter of fact, even if they did, they couldn't reduce spending enough to solve this problem, right? So which one are they going to choose? I think both. So when you take a look at where taxes have been, I mean, taxes are no fun to pay right now, but look at where they've been historically. Historically, we're in a very low tax rate environment versus where we have been over the long haul. And that should make us think about our choices that we make with our money today versus going into the future, right? So again, things that make you go, what we should look at? Well, let's take a look at the tax effect on your money. So this is a simple drill that just shows if we took $1 and we gave it to RJ, and RJ was amazing at investing, and every year we were able to double our money, right? That $1 over 20 years would turn into $1 million if it wasn't taxed at all, right? But what happens if every year on that 100% return we got, it was taxed by just 10%? Anybody have a guess of how much this $1 million that it accumulated to would be reduced to with just a 10% tax rate? Go ahead and type it in the chat box. I'm gonna peek over here and see if I can see it. Right? Someone's saying, oh, that was the number of people. Anyone want to type in there how much you think this is reduced to? 200,000, 400,000, 100,000. All right. Let's see what we come up with. 400,000. All right, we're getting there. We're getting there. The tax impact of reducing this, $375,000. 67% is reduced by just a simple 10% tax rate. Isn't that eye-opening? How about a 20% tax rate? 88% of your wealth has been eliminated at a 20% tax rate. And at a 40% tax rate, 98% of that compounding is left after taxes. So when you take a look at this, taxes will kill the compounding growth of your money, right? One of the keys to wealth accumulation is the elimination of taxes. And there's wealthy families like the Rockefellers that have been following these principles for 100 years. And it's made a big, big difference in their family wealth. So if this is important to you, if taxes and the effect of the taxes on your personal income, your personal wealth transfer, your family's wealth, if that's important to you, I'd encourage you to go into the chat box and just type in tax in there. So RJ knows that taxes are really important to you, right? So let's talk about taxes. We can't avoid taxes, right? We can't practice tax evasion. You'll end up in prison. We can't do that, right? So we're going to have to pay our taxes. But the question is, how do we pay our taxes? Do we pay our taxes now? Do we pay our taxes later? Or do you pay your taxes never again? If any one of you if you guys could pick any one of those columns, comment into the chat box if you would pick anything other than the tax me never again on my money. I bet there's going to be very few comments rolling in right now. But the question becomes, what type of assets fall into those categories? So when you think about tax me now, those are things like your current income, savings, CDs, mutual funds, bonds or fixed income, dividend paying stocks. All of those things you're going to get a 1099 on at the end of the year, and you're going to pay your taxes on the growth of that money. Tax me later, or anything that you have taken a tax deduction off of your income and put it in there and said, I'll pay you later. Those are things like your IRAs, 401k, real estate, maybe your business valuation, non-dividend paying stocks. When you look at Tax Me Never Again, there's really only two reasonable choices: Roth IRAs and Roth 401ks, which could be not available to you if you either make too much money or not have earned income, or cash value life insurance that's structured appropriately. Municipal bonds could potentially follow in there, but the yield is extremely low right now, and municipalities have a high debt ratio on them right now. And I would caution most people about looking at municipal bonds because of the risk of potential default, because unlike the federal government, municipalities can't print money, right? So let's talk about this, because I'm going to come out and tell you that I don't think you should be taking money and putting it into the tax me later bucket. If you're going to have to pay at a higher rate in the future, why should you be doing that now? I won't. Me personally, I will not put money into that category for myself. But we've been taught to do that for the last 40 years, right? So why was it innovative? Why should we change our thinking now if this has worked for so long? So let's go back. The 401k was passed. It was brought to plan in 1980 by someone by the name of Ted Benna. Ted Benna was a benefit consultant, and he used a tax act that was passed in 1978. It actually went into the IRS Revenue Code 401 subchapter K. That's why the K is in those parentheses. That's referencing the IRS Revenue Code where that came from. But when we take a look at the final paragraph here, it says the tax advantage of the 401k depends on four factors, all of which have changed dramatically since 1980 to the detriment of 401ks. For a median income married couple with two children, let's take a look at what that means, right? So if you're a median income family with two children, in today's dollars, right, that's about $100,000, $110,000. If you take that ratio back to 1980, the same amount of money is worth about $43,000 when adjusted for inflation, right? What do you think the tax bracket is right now for a $110,000 couple with two children? You can type it in the chat box if you want. I'm going to give you the answer here in just a second. It's 12%. Look at what it was in 1980. In 1980, the tax bracket was 43% on someone who at the same revenue today would be taxed at 12%. So Ted Benna came up and said, Mr. or Mrs. Joe Lunchpail, if you're going to save $1,000 for retirement, we got two choices. Choice number one says, let's pay the government their 43%. Let's pay the government $430 in tax, and we'll take the $570 that's left over and we'll save that for your retirement. Or option two was, let's take a deduction of that full $1,000 off your income, so you end up with the full $1,000 a day. We'll let you compound that for 30, 40 years, and when you retire, you probably would take that out in a lower tax bracket. Did that happen? Yes, look at it. They avoided tax at 43% and they're paying it at 12%. It was brilliant, absolutely brilliant. On top of that, it avoided capital gains. Capital gains tax was 28% back there. Now it's 0. And even more so, in 1980, we could put money in the CD at 15%. So you could take a deduction, avoid capital gains and income taxes, and compound it at 15% to arrive today taking it out in a 12% tax rate environment. It was brilliant. Brilliant, right? What about high income people? If you made 100,000 in 1980, that's equal to about 600,000 a day. The tax bracket then was 70%. Today it's 37. So if you think about that, for that top amount of money here, 100,000 here, you're taking home 63,000 to your family. Doesn't feel all that good, but imagine taking 30,000 home to your family after you went to work, right? Capital gains taxes are lower, CD rates are the same. I'll actually share a story with you real quick. Most of you might have heard of someone by the name of Ronald Reagan. Ronald Reagan obviously was a president, but prior to being a president, back in 1944 and 1945, he was a movie star. And in his autobiography, he said he would only make 2 movies per year. Why? Because after the second movie, he was in the top tax bracket. And you know what the top tax bracket was in 1944 and 1945, if you remember that graph we looked at? 94%. 94. And the state of California took the other 6. So literally, if he would have made that third movie and went to work and made money, the government would have taken 100% of that money. What was his incentive to make a third movie? 0, no incentive. Isn't that crazy? You think about it. So while it was brilliant in 1980, does it make a lot of sense today? Mathematically, I don't think so. So if you want to take a look at the experts, the real experts, the people that understand tax and compound interest and all those things, not the people that are down at the coffee shop, just talking about their opinions, but the real people that know it, people like Ed Slott, who was a PBS host and the tax advisor. He's been all over PBS. He's got 5 books. He's been known as America's IRA expert. What do they say? Ed says that the single biggest benefit in the income tax code is the tax exemption for life insurance. Life insurance. Well, why would he say that? First, let's take a look at it. Number one, we're in the historically low tax environment. So if you pay your taxes today at this low rate, all the money that compounds into a bigger amount is not taxed then. Taxes could be higher in the future. There's recent incentives that expire at the end of 2025, meaning tax rates by default will go up. And now you have the ability to move money from the tax me now and tax me later to a tax me never situation. Extremely powerful, right? But why? Why would we want to do this? Let me ask you a question. If you're a farmer like this, would you like to pay the tax on the seed, allow those to grow, and not have to pay your taxes on the crop? Or would you rather defer the tax on the seed and pay the taxes on the crop? It's as simple as that, right? Do you want to pay your taxes on a small amount or a big amount? Now, if the tax brackets are going to go down, right, that would maybe make more sense, but mathematically, I don't believe they are if you take a look at it. So I'm telling everybody across America to get control of your money. If you don't trust the mathematics of the government's situation, if you don't feel that they should have control of your money, you have to do it. You got to get control. And I urge you to consider the 100-year-old product that banks and billionaires have used to create tax-free growth and tax-free income, right? And it's called cash value life insurance. Now, before you hang up and go away, I promise you, this is not your grandfather's life insurance. You've probably heard that life insurance is a bad investment with low returns. And I would agree with you that at times that has been the case, for sure. But do you think there's been any innovation? Has the world changed at all in the last 20, 30, 40 years? I mean, does anything ever get better? Does anything ever change? Right? Right? Do you think it's possible that the good old fashioned cash value life insurance could change as well? I'm here to tell you that it has. I'm here to tell you that it has. 99% of people don't know that, and 99% of financial advisors don't understand that either. So let me ask you this question. This is a fair question for you to ask yourself, right? Banks are telling you to put money in CDs so it's safe, but they have horrible rates of return. Do you think the bank takes any of their own money and puts it in CDs? None, none. People will tell you to go put your money in mutual funds and hope things are going to get better, right? But do the banks do that? Do the super high net worth people do that? No, that's not where they put their money, right? Big banks, the ultra high net worth families, and major institutions, where do they park their money? They use cash value life insurance, and they do it by the billions. And I can prove it to you. I can prove it to you. I'll never tell you something that I can't prove, right? Why would these banks and ultra high net worth people invest in cash value life insurance? Let me show you. They're doing exactly what Susie Orman and Dave Ramsey tells you not to do. But, Dave Ramsey spends his entire life telling you to eliminate your debt, right? But what happens when you go into retirement with a $2 million IRA? You haven't eliminated the debt. You still owe taxes on that $2 million IRA, right? Right. So the truth is that banks are looking for sound, solid investments. So let's go to this, right? Institutions understand how these products benefit them and they benefit you as well. When you take a look at banks, tier one capital is a certain amount of requirement that banks need to have on hand in order to lend, in order to make loans. And tier one capital is considered the safest, most highest quality capital that's out there. You know what qualifies as tier one capital? Cash value life insurance. So let's take a look at Wells Fargo, JP Morgan Chase, Bank of America, Bank of New York Mellon, PNC, right? If you go to FDIC.gov, you'll take a look at their tier one capital holdings. And look at this. They also are forced to tell you how much they have in cash value life insurance. Wells Fargo, 18.2 billion. JP Morgan Chase, 10 billion. Bank of America, 20 billion. PNC Bank, 7 billion. Bank, these are billions and billions of dollars of cash value life insurance that banks own. Why? How about real smart people? People that know a thing or two about business. How about Ken Lewis, the Bank of America CEO? He's got $53 million in cash value life insurance. Randall Stevenson, 41 million. The Boeing CEO, 34 million. Coke, 39 million. Comcast CEO, 232 million. Right? Exxon, Rex Tillerson, 43 million. These folks have millions and millions of dollars in cash value life insurance because they understand how it works. What about a football fan? Anyone here like football? Jim Harbaugh, I don't really like this guy. Number one, he was a quarterback for the Chicago Bears. I'm a Green Bay Packers fan. And number two, he's now the head coach at Michigan. And I'm a Wisconsin Badgers fan. But he's a very smart guy. He's a very smart guy. He takes 100% of his compensation from the University of Michigan into cash value life insurance, 100% of his compensation, right? Why? Because it's going to design to provide him millions of dollars of tax-free cash during retirement, right? That's why. Tax-free income. Isn't that the goal? Right? Tech billionaire, what could they invest their money in? They bought a $200 million life insurance policy. So if your cash flow is important to you, how much income you're going to have, and knowing what you can actually spend because you know what you're going to have after tax is important to you, just type cash. Type cash in the chat. I'd be willing to bet you're in retirement, or as you get close, you start thinking more and more about cash flow. So what RJ and I want to share with you is some of these alternative opportunities to use these types of vehicles to create this type of benefit for yourself. So the number one alternative solution in America right now is something that's called structurally optimized life insurance. If you buy something off the rack, let's call it a suit or a shirt, right? Is that suit tailored and automatically going to come off the rack and work beautifully for you? Probably not. Most life insurance policies aren't going to work that way either. They need to be optimized and structurally designed exact to your specifications, right? So let's talk about how this works, just basic 101 so you get the understanding. If someone decides to put money in with a general in an insurance company, life insurance company, and they put it into the general account, they establish first how much do they want to put in, right? Those CEOs are putting, big millions, multi-millions into this strategy. Because once it's in there, it's the safest place in the world you could ever park money. Nobody has lost a penny in a general account of a cash value life insurance company in the history of America. From there, because it's regulated by the states and the federal government, what they can put their money into, and it's very, very, very safe, they produce death benefits. That's a benefit to your family and estate and all those planning pieces, right? And the death benefit is more than what you're going to contribute into the plan. But that's all these guys are doing it for. They're doing it for the income, the dividends. And historically, those dividends could go into whole life. And whole life many times has been said it's a bad investment. And it's not a bad investment. It's a beautiful investment for what it's supposed to do, right? It's kind of like a savings account. It's designed to earn you 3, 4, 5% per year, year after year after year after year. And it's done it for 180 years. That's not so bad. It's not so bad, right? But what if you want to have a higher rate of return? What if you want market like appreciation? Well, all of this works the same, other than we get to use options. We get to use options. And with those options, we're able to get a higher rate of return on your capital. It's beautiful, right? We can get you market like returns on your cash, on your portfolio, with far, far, far less risk. And I can prove it to you. Prove it to you, right? So right now, when you hear that, you're probably ready to run, because it sounds too good to be true, right? And if something's too good to be true, it's number one, it's not too good to be uh, uh, true. It's too good to be free. Nothing is free. You need to understand how that works. But let's think about this. How is something that heavy able to get off the ground? Something that heavy? How's something that heavy able to fly? I don't know if you guys saw the news this week. I saw the video on Facebook of that engine that caught fire in Denver, and that plane had one engine that didn't even work, and that thing didn't even crash. It made its way down to the ground safely. I would think that if one engine shut off, the plane would just spin around in circles because you're getting all the thrust from one side. But I mean, it was amazing what happened, right? It's math and science. It's the math and science and the engineering that goes in these vehicles of what's going to give you the benefits that you want, the benefits that come out of the backside that benefits you and your family. If you use the math and science appropriately and you understand the math and science, you'll understand that it's not too good to be true. And we'll explain to you exactly how that works, exactly how it works. So there's three big main strategies that I wanted to hit on quickly here before we end our time together today. And what type of people would use something like structurally optimized life insurance? First, someone who owns a business. If you own a business and you are looking to put money away, like you saw those corporations, those banks that are doing, corporate owned is a great strategy because it's tax deductible to the business, it's tax neutral to the business owner, it's tax free on the death benefit, and all your future income that comes out of that is tax free as well. It's a beautiful strategy for those that own a business, right? What if you have a highly appreciated asset and you have to pay a bunch of tax on it? Has anyone sold a piece of real estate, or maybe sold a business, or they're planning on doing it this year, next year, the following year, right? Being able to use this strategy to produce collateral that will allow you to have a tax-free death benefit and tax-free income, even on the money that would have had to go to the government in taxes. We can show you that strategy. It's a beautiful strategy. Will save your family millions of dollars over the long haul by using those strategies. And what about just plain old tax-free retirement income? Tax-free retirement income is beautiful. We can use IRA conversions. So if you have money that's already in an IRA or a 401k, we can reposition those dollars into tax never dollars, and the tax money doesn't have to come out of your pocket to do it. It's a brilliant strategy. We're able to move that money from tax me later to tax me never ever again, right? And that tax neutral event to your pocketbook. It's beautiful. It's a beautiful option. So I'm going to bring RJ back on, but our offer for you today, this evening, this afternoon, is really to take a look at what a tax-free analysis looks like for you. Now, we don't need you to bare your soul and tell us where all of your statements are and show me all those type of things. We really, from a high level, want to show you how you can break your assets down into the categories of tax me now, tax me later, tax me never again, and use those assets to create a plan that's going to create tax-free situations for you and your family for the remainder of your life. And that's what the first step is to be able to have that type of conversation and gather some information so we can put that together for you. That's our offer, and it's completely 100% free. So if this is something that is interesting and meaningful to you, I would encourage you to go to the chat box there and put your type in offer, or type in talk to me. RJ will know how to get in touch with you. RJ, I'm going to turn it back over to you. I'd love for you to obviously share these folks your contact information so they know how to get a hold of you as well. But anything that you'd like me to share with you as well in the last few minutes, RJ, back to you, my friend.
Thank you, John. That was just such an amazing presentation. I think, most people will agree. Type in yes if you agree with what the presentation John just did. I thought it was just amazing because he really does summarize perfectly the biggest challenges that we have right now, the taxes and the future taxes as well, too. Now, whenever we talk about any strategies, we know that, one solution is not right for everybody because everybody's positions are a little bit different. And that's why we do work with a lot of, different solutions, for different situations. So if you are interested in a free consultation or discovery call, as I like to call it, you will be getting an email after this presentation, if you register for it, where you will be able to see my scheduling link. And it'll also have my email number and phone number, email and phone number that you can also call directly to if you want to just talk to me directly without the discovery call. Do we have any questions? Let's answer a few questions. I saw one that said, are you a fiduciary? And yes, I am a fiduciary. A fiduciary is basically someone who's a registered investment advisor, who has to take a little bit extra care to make sure that he's doing the best things for their clients. Any more questions, anything, just feel free to ask.
I put together, I'll share one final piece. I put together some T-shirts during the last election. There was two that I put together, and one of them had a checkbox that said Republican, and the second one said Democrat, and I gave the third option, which was math, and I had that box checked, and I wore that T-shirt everywhere during the election cycle. And I had another one that was made that said math 2020, and I had another one that was made that said math never lies. Folks, that's what it's all about, right? We're just math nerds that go through and do these type of analysis to prove to you on a factual basis with the math and science what is going to be most advantageous to you. So I look forward to speaking with you again. I know RJ and I are going to continue to provide education to those that were invited here today. We'll have the ability to work with you on a one-on-one basis, as well with some of these opportunities. So I'll look forward to that. Dale, are there other financial products in life insurance? Yes, for sure. Everybody's situation is different. So yes, many different products. And Charles asked a question, how do you overcome health requirements or age factors? Health requirements and age factors is life insurance. If you are using cash value life insurance, does need to pass a healthcare physical, but there are ways to deal with that. For instance, a husband could have worked and saved all of the money, and we actually place the policy on his bride, on his wife, because she has a higher health grade than her husband would, or vice versa. Younger people under 50, what happens if you're over 50 because the time available to grow your account? These strategies can be very effective over the age of 50. As a matter of fact, about 85% of the people that we work with these strategies are over the age of 55, and it is optimized for them mathematically. That works beautiful. So great question on that one. Is there any website to read more about these cash value life insurance product with some calculators? RJ has the ability to do that for you. I would encourage you to respond to his calendar link in the email and book direct on that calendar. There were over 100 people that have logged in here today, and he's going to be a busy guy these next couple of weeks. So if you want to get to the front of the line, I encourage you to respond to that email and get directly booked onto his calendar. Can you briefly touch on disability insurance? Disability insurance is a key component to anyone that's a high net worth individual. And many times, if you do have disability insurance, even at work, I would encourage you to speak with our team of experts in regards to that, because there's a lot of exclusions that happen into those group plans. We have one of the best experts in the entire country in regards to disability insurance that within 20 to 30 minutes can give you a lot of guidance on where the gaps in your current plan is, or hopefully just gives you a pat on the back and says, awesome, everything you got is beautiful and well taken care of. But yeah, we can definitely help you out with that, Dale. Thanks for your comment. Well, it looks like that's most of the comments. RJ, thanks again for the opportunity. It's always a pleasure working with you. You're a class act, and the folks that you work with are always a pleasure. Such wonderful folks. So
Thank you, John. Thank you so much for spending your time and knowledge with us.
my pleasure. My pleasure. We'll see you guys again sometime soon.
Yes, thank you, everyone. Thank you for joining us, and have a great day.